Hello guys, I hope you are doing good. So we are going to see the second chapter of the second part of this course, which is candlestick patterns and price action. So in technical analysis, a candlestick pattern is a movement in price shown graphically on a candlestick chart that some believe can predict a particular market movement. The recognition of the pattern is subjective, and programs that are used for charting have to rely on predefined rules to match the pattern. There are 42 recognized patterns that can be split into simple and complex patterns. In this chapter, we'll see only the important and the most accurate patterns. In technical analysis, transition between rising and falling trends are often signaled by price patterns. By definition, a price pattern is a recognizable configuration of price movement that is identified using a series of trend lines and/or curves. When a price pattern signals a change in trend direction, it is known as a reversal pattern. A continuation pattern occurs when the trend continues in its existing direction, following a brief pause. Technical analysts have long used price patterns to examine current movement and forecast future market movements. So in the first case, we are going to see candlestick patterns, then we have to pass to price actions. A doji is a name for a session in which the candlestick has an open and close that are virtually equal and are often components in patterns. Doji candlesticks look like a cross, inverted cross, or plus sign alone. Doji are neutral patterns that are also featured in a number of important patterns. A doji candlestick forms when open and close are virtually equal for the given time period and generally signals a reversal pattern for technical analysts. This is how the doji looks like. So the markets open here and the price rise up until here the high and falls down and close here to mark a very small body. The open price and the close price, it's not very important to be the same to qualify this candlestick as a doji. It can have a small body, and we will consider it as a doji. And the color of the body, it's not important if it's blue or red. So in this kind of candlestick, we just see the high and low. In forex trading, we tell in this a tail. Well, we see in the tail and the body. In the second point, we are going to see hammer and hanging man. A hammer is a type of bullish reversal candlestick pattern made up of just one candle, as it has a long lower wick and a short body at the top of the candlestick with little or no upper wick. When you see the hammer form in a downtrend, this is a sign of a potential reversal in the market. A hanging man candlestick is the same as a hammer but forms in an uptrend, and it's sign of a potential market reversal. So we naming hammer if we find this candlestick in downtrend. For example, we have here a downtrend. At the bottom of a trend, we see this candlestick. We naming that candlestick as a hammer. It often signals a potential trend reversal, like this. The hanging man is the same candle, like this. Generally find a hanging man in an uptrend, in the top of an uptrend. The hammer and the hanging man are same candles, but we change them depending on the trend. If the trend is an uptrend and we found this candlestick at the top, so we're naming that a hanging man. If it's a downtrend, we're naming that a hammer. It's a sign of a potential market reversal. Okay. In the third point, we are going to see inverted hammer and shooting star. So the inverted hammer is a type of candlestick pattern found after a downtrend, and it is usually taken to be a trend reversal signal. The shooting star is the same candlestick as inverted hammer candlestick pattern, but found after an uptrend, and is usually taken to be a trend reversal. So the inverted hammer and the shooting star are the same candlestick pattern, like this. This is the candlestick, but we differ that with the trend. If the trend is a downtrend, so we're naming that as an inverted hammer. If the trend is an uptrend, we're naming that as a shooting star, and it usually signal trend reversal. So if we see that and the trend and the next candlestick goes to confirm this candlestick pattern, and generally the trend reverse. Next, we are going to see bullish engulfing and bearish engulfing. These two candlestick patterns are very important. You have to understand that also. I mean, all the candlestick patterns that we saw in this slide are the most important candlestick in technical analysis. So engulfing, bullish engulfing. The bullish engulfing pattern is a two candle reversal pattern. The second candle completely engulfs the real body of the first one without regards to the length of the tiled shadows. The bullish engulfing pattern appear in a downtrend. So this is the bullish engulfing pattern. We have here a candlestick, and the next candlestick will engulf the entire body of the previous candlestick. This is what we call in a bullish engulfing, and it usually a signal of the trend reversal, and vice versa for a bearish engulfing pattern. The last candle will engulf the entire body of the previous candlestick with a bearish. This is a bearish candlestick. It is a sign of trend reversal. So we are going to see here price action. In technical analysis, transition between rising and falling trends are often signaled by price pattern. By definition, a price pattern is recognizable configuration of price movement that is identified using a series of trend lines and or curves. When a price pattern signals a change in trend direction, it is known as a reversal pattern. A continuation pattern occurs when the trend continues in its existing direction following a brief pause. Technical analysts have long used price patterns to examine current movements and forecast the future movements. So here in price action we have 2 points, the continuation patterns and the reversal patterns. So the continuation patterns are generally like here a flag or a triangle. So if we see if we can draw a triangle in a down in an uptrend or a flag, this is a continuation pattern. That means that the market will do a brief pause, then break up the flag or the triangle to continue his uptrend, and it's the same case for a downtrend. This is a triangle or a rectangle, or we name in a flag. like this. If it's go like this, it's like a flag. So in the second point, we are going to see the reversal price action patterns. So in reversal price action patterns, there are a lot of patterns, but what we are going to study is just the double top and the double bottom. So a reversal pattern is a transitional phase that marks the turning point between a rising and a falling market. As we can see here, we have a downtrend, a bottom. This is the top, and the market will draw another bottom. He will try to break down this previous bottom, and he cannot do that and reverse up. We can confirm that this is a true double bottom after breaking up the previous top and test the previous top. So we qualify this as a confirmed double bottom. It's the same case to double top. We have here an uptrend. The market will draw a bottom here, and the market will try to break up this last top, and he can't break it up, and the market will drop down and breaks down this previous bottom and test it. We confirm that this is a confirmed double top. So we will illustrate all what we study in this chart example. So as we can see, in the first place we have here a double top. A double top not confirmed. To mark a double top confirmed, it need to break the last bottom, and here the market didn't break this last bottom. Okay, and also we have double bottom here, a double bottom confirmed. The market breaks the last top here, and also it's a resistance, and the market turns and the market pulls back to test the resistance and also the last top of this double bottom. And here it's a confirmed double bottom reversal. What we will remark also that the market always react in this resistance level and this support level. Here also we have a doji. We have here a bullish engulfing pattern, because this is a correction, is ended by an bullish engulfing that signals the end of this correction. And here we have shooting star confirmed by bearish engulfing pattern, and also here we have a lot of hammer, doji, and bullish engulfing also. As we can see here, also shooting star confirmed with a bearish engulfing pattern. Here also we have a bullish engulfing pattern. Here we have an unconfirmed bearish engulfing pattern. These things that we see right now, it's the basic things of a forex market. So when you open up your trading platform, you will see in the daily basis all these aspects that we study in this chapter. You have to understand these concepts that we developed in this chapter, and try to do some exercises to practice this in real chart to master this technical analysis. So here we developed all what we need in technical analysis for scalping: support and resistance, price action, candlesticks. So we developed all technical analysis basics. This is the end of this chapter. I hope you guys understood very well this chapter, and see you soon.